on all the social channels. Welcome to the 10K Collective podcast, a subset of the amazing FBA podcast. We're actually going to record a podcast live in a minute. We're talking with Rob Te Braake, I hope I got the name right, about accounting, and particularly how to make accounting over here a job to do, which most of us don't go, wow, I love that, and meet the reason we got into business in the first place, which is getting wealth
Yes.
and freedom and all that good stuff. So Rob, thanks for coming on the show. Welcome.
My pleasure. Thanks for having me.
Pleasure to have you as well. So this is a great topic. I love accounting is going too far. Like everyone else, I've literally seen entrepreneurs have a nosebleed in a meeting I had with a mastermind of Amazon sellers a few years ago, from doing accounts till from 4 a.m. And yeah, it can feel like that sometimes. But I think if it's done right, it's just a big power skill set that most of us ignore and chase after. What's the latest marketing hack? And there's nothing wrong with the marketing hack,
Yes.
but I just think it's, for any grown-up business person, the wrong direction of focus. So if you're listening live, thanks so much for joining us, or on the replay. Do pop any comments or questions. I will keep an eye on the chat, and if we can weave it into the discussion, if it fits in, we'll do that. But if not, then Rob or I will come and look at the comments afterwards on the social channels, and come back to you with hopefully intelligent responses, certainly from Rob, I'm sure. So that said, this is mostly a sort of live podcast recording. So let's get going with that. Rob, are you good to get going with the recording the podcast?
Yep, let's go.
You pledge your life to Jesus. I've probably just offended like 15 people out there, but anyway, yes, let's do this thing. Here we go for the podcast recording. I'm going to change the view to speaker view as well. Right, and the camera will come back to me. Hopefully, yeah. Here we go. A little bit of meeting information. Just give me 1 second. Yes, here we go. Ladles and jelly spoons, boys and girls. Welcome back to the 10K Collective podcast. Should we just do that one again? Because the cough kind of got the camera to you. Right, let's do it again. Get my t-shirt looking good. Okay, this is the behind the scenes, folks. If you're watching live, this is the ugly truth of podcast. Here we go. Ladles and jelly spoons, boys and girls. Welcome back to the 10K Collective podcast, the place to be for 6, 7, and 8-figure, I should say, Amazon sellers, subset of the amazing FBA family of podcasts. Today, we're talking to Rob Te Braake, and we are talking about how to tie together, on the one hand, the dream, the reason we got into the whole business in the first place, your personal wealth goals, and on the other hand, your accounting, which can often feel just like a burden and a why are we doing this kind of thing. So Rob is an expert in accounting, particularly for e-commerce, and a great topic of conversation. So Rob, welcome to the show.
Pleasure to be here.
So where are you coming to us from, Rob? Tell us a little bit about your international background here.
As you can probably tell by my name and my accent, I am Dutch, but I spent the majority of the last decade in Asia in various places, mainly China and Thailand, but I'm currently based in Budapest in Hungary.
That's quite the variety. So you've got an extremely international outlook, which I think is really, really helpful in a very globalized business, i.e. e-commerce. So what are we talking about here? So we're tying personal wealth goals and e-commerce accounting. In theory, that is a fantastic thing to do, but let's define the subject area. What do we mean by personal wealth goals to start with?
Well, let me turn it around. As you mentioned in the intro, people start a business for a reason. And a lot of times that is freedom or wealth or just really not wanting to work for a boss. And what I've seen is that people run a business, especially if freedom is the objective, they run it without a specific goal in mind. And that means that they're going to have an amazing journey, but they have absolutely no clue where they're going to end up. So in my eyes, the foundation of the business is what you want to achieve with it. So your personal goal, whether that is a lifestyle business or whether that is becoming the next Jeff Bezos, that will drive a lot of the decisions you're going to make in the business. And therefore, they are very, very closely connected.
Interesting. So this comes down to goal clarity, I guess, which is
Yes.
quite a huge topic. So next question then, why does goal clarity really matter? I mean, surely if you just make money, as people say, whatever money means, and we can discuss that obviously to an accounting expert, but okay, I want to make money, doesn't matter about goals. If I see the money coming in, I get to choose afterwards what I do with it. What about that? Why does that not work?
If that makes you happy, if that works for you, be my guest. But I don't believe that that's optimal. You're not gonna just put some Facebook ads up and see if it runs, or a couple of Amazon ads up and see if it runs. You want to do it as good as you can, because that's going to get you the best results. And the goal that you have has a massive impact on how you run your business. If you want to grow as big as possible, you want to invest as much as you can in revenue growth. And you don't care so much about profitability or a lot of the other possible metrics. Well, if you are a bootstrapped lifestyle business and you want to have a good income and minimize how much you work, and you don't care so much about reaching 9 figures in revenue, you're going to have a completely different mindset on the decisions that you make in terms of how much to reinvest, what to pay yourself, how much risk you're willing to take. So having that goal clarity translates into every strategic decision. And every strategic decision, of course, rolls down into more practical and operational decisions.
Okay, like it. I like the structured way of thinking, strategic decisions, and then operational decisions. And by the way, if you can hear me tapping at my computer keyboard, I'm not seeing what my mum's having for dinner. Making notes for you folks. So if you want to check them out at 10kcollective.com, we'll make a few notes and capture any links that are helpful for you. Yeah, so let's talk about this then. I find that people often want to have their cake and eat it, and this is a bit of a phrase that our Prime Minister's made a bit infamous in this country. I'm pro having my cake and pro eating it, but the fact is that, as the the little phrase implies, we kind of need to choose one or the other, but not both.
Yes.
I know quite a lot of people that want to pay themselves and then also expect their business to grow, despite the fact that they're taking all the money out of it. So, is that a common mistake? What sort of the classic mistakes that you see when it comes to um, lack of goal clarity in this area?
Yeah, well, lack of goal clarity leads to lack of clear decisions. Indeed, people want everything. But the key things that we see that goes wrong, and again, it depends a bit on what the personal goal is, but taking too much money off the table is definitely one of them. And we see that mainly with people that are running it as a lifestyle business. They take too much money out, therefore they have too little left to invest in product development or in marketing or in branding, and that's going to harm the long-term growth. The opposite side is also true. We see people take too little out, and they keep reinvesting money, and that's especially in ads, even though they're not as profitable as they should be. So they keep working hard to make a little bit of money, put it back in, only to get little to no return. So they're in this hamster wheel that keeps running. Their personal life doesn't get better, the business doesn't grow. So that gives a very awkward catch-22. Too much risk-taking is, especially with first-time entrepreneurs, a really recurring one. Put all the cash that you have available into the launch of one new product. And if it fails, immediately they have a problem, they're running out of cash, and immediately they're in the corner. That is the most easily avoidable mistake. Another one that we often see, unfortunately, is people that stare blind at one particular metric, whether it is revenue, which would be an absolute disaster, or even if it's customer acquisition costs. We have one client who was focusing completely on customer acquisition costs because they were trying to get that one down so they would be profitable on the first order. And they spent a couple $100,000 on ads, burned through a couple $100,000 in ads before we got on board, and we told them, look, if you keep doing this with the pace that your acquisition cost is going to go down, you'll be bankrupt before you're profitable. So keeping your eye on one metric and thereby forgetting all the other factors is also a really common and potentially disastrous mistake.
Wow, this is sobering stuff, but hopefully, I mean, I want to say anyone listening to this getting a bit depressed, that the good thing about finding a mistake is you can fix it. I mean, I think living in denial, pro having one's cake and pro eating it, not casting any aspersions to any British politicians, because I can't be bothered to get into political arguments, but trying to have your cake and eat it normally is a sign that you're deluded, and if you're deluded, at some point, what feels fun comes to an end. And then obviously it's extremely unfun if you go bankrupt, or lose your house because you've got it, a loan secured on it, or other unpleasant things that can happen. So I would suggest that whilst we're talking about grasping unpleasant nettles, if you can solve this, the flip side is there's great stuff on the other side, right? I've got to say that just in case it sounds very depressing. However, let's dig into this because I see a few of these things around. Let's talk about what stages of business it's appropriate to look out for these things, and indeed when what are the classic sort of stages of business you see that coming up. So first of all, taking too much money off the table. Let's talk about how to solve this. Lifestyle businesses, so in other words, people aren't that ambitious to grow a huge business, and we can see obviously that it's basically going to kill the business because you haven't got the money left in it. So what's the solution to that, and who let's, before we even talk about solutions, let's talk about what are the signs that you're doing this in your business. Let's talk about this first. Let's diagnosing the problem, and then we'll talk solutions. So what are the signs that somebody's doing this in this business, and who is particularly vulnerable to this at what stage of business growth?
To start with the latter one, the group that we see most vulnerable for this are people that care only about their lifestyle and really treat their business as that thing that funds their lifestyle. Because they're not so much interested or vested in the financial health of the business, they're spending most of their time and effort on how to live that perfect lifestyle. So the classic tale for that is if your management fees or your director fees or your salary, whatever you want to call it, or whatever it's called in your jurisdiction, if that reaches more than a certain percentage of your gross profit, you really want to be careful.
Okay, and what percentage would that be? I know it's a kind of how long's a piece of string, that depends, but give us some rough ideas that at least that should be a flag for investigation.
If it's more than 20% of your gross profit, I'm gonna get nervous. Because in general, let's say you have about, let's say 60% gross profit, 30% ACOS, that leaves you 30%. And if 2/3 of that goes to your salary, there's probably not enough meat on the bone left to invest in growth, invest in a quality team, and other things that you need to scale the business.
Interesting. I would say that the typical gross profit numbers I see is assuming that by defining gross profit that all your direct costs minus your advertising for selling would typically be 30 to 40% in most of the entrepreneurs I've worked with at scale, doing 6, 7, 8, maybe 8 figures. 30% ACOS is pretty high, but I mean 10% is more typical, but 30% at the bottom end of it sounds to me on the higher side. So after ads, all the gross profit, so everything before your overhead. So that's quite a realistic number, 30%. I would say it's quite often going to be more like 20%, and then you take a bit of overheads off. And
if you're better in your marketing, or if you have a better niche, then yes, it can be lower. We've seen it substantially lower. I've also seen it a lot higher.
But let's do a reality check. Let's do very quick maths for people here. So I want to wake people up if they're listening or watching and hear this. If we've given you a wake-up call right now, you're not going to like us for it, but I think we're potentially saving your business life. So it's like a visit to the doctor's office that you don't enjoy, but thank God you went. So 20% of your gross profit, let's assume 30% growth mark. So 20% of 30%, let's try and word this out here, is going to be what? This is terrible. My maths is so bad. I can't. 6%. So 6% of your revenue, right? That you shouldn't, that will be a worrying figure, which is quite sobering. So if your business is doing $100,000 a month and you're taking out $6,000, you're already worrying Rob. And by the way, 30% gross profit margin, quite healthy, I would suggest. And we haven't even talked about overhead. So that's quite a sobering percentage, right? That actually, I know some people have literally had a business doing a few $1,000s a month and went and lived on a beach in Thailand for a while. Even had one product, and needless to say, that went horribly wrong. And then a couple of years later, I was working with them to try and rebuild the business. So that didn't work very well. So thank you for the reality check.
Quick note here. This is really based on the assumption that you're looking to build a sustainable long-term business.
Yeah.
We are now currently also working with an e-commerce company that found a niche that works, and an ad combination that works. And they know that this is not sustainable because this market, that their specific niche is going to implode or be cannibalized, or that will go away. They are extracting every penny they can because they don't believe it has long-term potential. So it doesn't necessarily mean you shouldn't take more off the table, but it has to be a very deliberate choice. You're muted.
Sorry,
Yeah.
schoolboy error there. Yeah, I would say also if you are taking money out of a business because you believe the business is dying, then you should take it out pretty damn quickly.
Yeah.
But also, I would suggest you don't want to be spending on lifestyles like holidays or cars or whatever else it is that floats your boat, or even more responsible things, things like private school fees for your kids or whatever it may be, because you're going to need to build up an alternative income stream pretty quickly, aren't you? So I
Yeah.
guess what you should do is put it in cash and then maybe invest it in real estate slash property, depending on the side of the pond you're on, etc. Right. So yeah, okay, that's quite sobering. So that's the person who's vulnerable to it. I guess the signs you're doing it is really more than 20% of gross profit. That's a really useful reality check. I think a lot of people in the early stages I've seen doing that. Now, taking out too little is somewhat tragic, isn't it? Because you're not even getting the fun of spending money on, fast cars and loose women or whatever it is you want to spend your money on. I see that as well in some of my clients that have got, say, seven-figure businesses, but low seven figures.
Yeah.
So who's vulnerable to this taking too little out piece?
I'm going to say this is usually people that are overly optimistic, um, more optimistic about the potential than the business at that point actually warrants. So I have one client in particular in mind. They've been saying for years that they are investing in this new marketing strategy that's going to lower the acquisition cost. But in reality, they have been spending and spending and spending, and they're burning most of their profits on trying to find that new marketing channel that works better. While my view there is they might as well cut that investment in half. It's not going to change the result much, and take out more to de-risk themselves personally.
Okay, so in other words, if it's not really working, it doesn't really matter if you do less of it. If that's what you're
Yeah.
saying.
If
That's really
anything, if it's
interesting.
not working, you may stop bleeding as much as you did before.
Yeah, yeah, yeah. By the way, we've got a message from an accounting from a Facebook user saying accounting yuck, but some great advice and content. Well, I kind of take that as a compliment. Obviously, we're dissing Rob's chosen profession here, but on the other hand, yeah, a lot of people are going,
Oh
oh God,
no,
accounting, I don't like it, but yeah, great advice and content. Agreed. This is great, Rob, because if you
slight,
reality check something bad, then you can start to do the good things, I guess, as well. Sorry.
true, slight correction there. I'm not an accountant
Not an
myself.
accountant. Okay, so correct me.
So to be honest, I personally also bloody hate accounting because the accounting work itself is insanely boring. But the value that you get from the work it's invaluable because it gives you the insights and the visibility that you need to make the decisions about the cool stuff. It is the
Yeah,
foundation that is absolutely boring, but it holds up the rest of the business.
great. Thank you for clarifying that. And I suppose what we're talking about here is really not the business of doing bookkeeping, because by the way, that is a hireable skill. I mean, you
Yeah.
really, if you're hating it, it's an anonymous user, Sally. I don't know what your name is, but if you're listening or watching, anonymous Facebook user who thinks accounting is yuck. I agree. By the way, my personal experience, most entrepreneurial types I know are not good at
Yeah.
bookkeeping, but you can hire that. And I think you should, for the simple reason, as you just said, the value you get out of the other end means you can have an intelligent discussion like this, hopefully, and make some conclusions about what you're going to do, which is the critical thing, right? So coming back to solutions, then we didn't really give solutions, by the way, for the person who's taking too much money off the table because they're lifestyle business. Assuming that you are taking out more than 20% of the gross profit and a management salary, what's the solution to this? Is it simply just stop doing that, or what are the other solutions?
It is all, in general, the advice is make a plan, figure out what is really important for you, what are you, and therefore, what are you willing to accept? Are you willing to accept that the business is underfunded or may go down the drain because you take too much off the table? Then fine, keep doing that. If that's a deliberate decision, it's your business. But in general, I would say if you're taking too much off the table, the solution is temporarily reduce that, invest that in future growth. And when that growth materializes, you can go back to the old level.
Yeah, I like it a lot. So it comes down to really a relationship to the business. So I suppose in a way, that person may not be, if it's a working business that's throwing off enough cash flow to fund a lifestyle even temporarily, then it may be that it's actually quite a promising business. So they are kind of undervaluing the future of the business, right? And it seems like the person who's taking too little out is overvaluing the future of the business. So either which way, it's kind of a mismatch between the entrepreneur's behaviors and their, well, no, it's not even that. Most their perception of their business versus the actual reality. Very interesting. Um, so, what other solutions have we got for the person who's taking too little out? So, investing less, but presumably, if it's not working very well, if you keep spending like crazy on ads and you're not really getting profits for show for it, then that says to me something more profound than just put less into something that's not working. My instinct would be to say stop doing what's not working and find something that is. I mean, what do you say to a client when you're working with them in that situation?
In essence, the same. We phrase it slightly different. I
Yeah.
basically say in that case, pay yourself first a base salary that covers your personal lifestyle, as long as it's somewhat reasonable. And that means that there's less money available in the business. And that means that they are forced to make decisions about where to stop spending.
Okay.
And
Yeah,
we'll
that's
guide them
interesting. Yeah.
towards cutting the things that don't work if they don't get to that conclusion themselves.
Okay, I like that. Yeah. So in a way, you're imposing a discipline not on your personal spending, as in sort of person number one who just
Yeah.
wants to go and sit on the beach in Thailand, but you're imposing a discipline on the business by saying, right, I'm going to keep this money for myself and my family. Interesting. So let's take an example of, I've seen this pattern with a, it's not untypical for a client or two that I've had in the past, where they'd say making about, say, just over $1 million a year in revenue. They've got some staff and some overhead, and the overall, I don't know what this structure is in terms of gross profit and overhead breakdown, but the pre-tax profit, so the operating profit, is pretty much about 5%, and they've got to split it between themselves and their business partner, which gives you about $25,000 profit per year. And of course, you can't necessarily eat profit because that's the theoretical thing, is it's not cash flow. So what would you say to a person in that situation? Because he makes my heart bleed, always has done when I've worked with him in the past.
Do
What
they
do you
pay
say to a
themselves a
person?
salary?
They
So is
are.
that profit like the bonus on top of the salary?
Very good question. I don't think that's. I think that they're not paying themselves at the moment. I think that's
Then they're not
actually.
profitable.
Yeah. Okay. Interesting. So, what would you say to that person? What was the advice? What do they do?
Pay yourself a salary, because the director's fee or your owner's salary should be in your overhead expenses. It is a normal cost of the business and the business needs to carry that. So if you don't have the cash flow, still book it. You may not be able to pay it, but still put it in your P&L as a cost, because otherwise you're deceiving yourself on how profitable the business is. You may look like you have 5% net margin. Well, actually, you're below zero. And that's going to change the decisions that you make, because if you're actually below zero, you should be either cutting costs or be more efficient in your investments, in your growth strategies, because you don't have that much margin to play with.
Yeah. Okay. Very interesting. I mean, so basically, what you're saying is you should book it as, so if you haven't got the cash flow, so obviously you took the money out of a business that's making basically no profit, you will kill the business. But what you could
Yeah,
do is book it, as you say. In other words, this business owes you, whatever it is. Um,
exactly.
$25,000 a year wouldn't be a great deal, but it would be a start for covering your base costs, I suppose. But and then the business owes you that, and then the next year maybe it owes you another 25,000, so the business owes you 50,000 overall in your director's loan account, right? Oh, that makes sense. And then I guess you need to cut costs and or increase efficiencies to the point where you can
Yeah.
actually get the business to pay off its loans that it owns to the directors. Okay, interesting. This is very, very wise advice. I like
And
that a
honestly,
lot.
for most, the number one place to look at cutting costs is cutting Skus. Um, I'm going to bet there's an 80% chance there are SKUs that you're actually making a loss on, because the velocity is too low. You have them in inventory, you pay for storage, you pay for management time, you pay for sourcing time. So in 8 out of 10 cases, cutting SKUs is one of the easier ways to free up cash flow and free up profitability.
Yeah, and by the way, we're going to talk about the difference between profit and cash flow in our next episode, which is kind of obviously something that people at the more sophisticated end of business owners and managers understand, but they kind of feel like that's the distinction for accountants. I would argue it's really, really critical, but you make a good point. And I think, yes, I've seen that a lot. That I've actually, it's really nice when your clients go and do the stuff you suggest, isn't it? It's always gratifying. And one of the clients in their 10K Collective Mastermind doing, I don't know, a few $1 million a year. I'm not sure exactly what the run rate is. It's varied a lot over the pandemic period does have a lot of people going up and down. But serious player and lots and lots and lots of SKUs, hundreds of SKUs on Amazon. And he went away and did an 80-20 analysis of which SKUs brought in his profit. And out of, I think at that point, 300 SKUs he had live on Amazon, I think 10 were producing, I can't remember what the percentage is, which is bad of me, but a big percentage of the profits, which is typical. And of course, the flip side of that, which he hadn't done, but which would be the harder, rather more soul destroying reality check would be, and 10% of them are losing us all, half of the losses. And yeah, you're right, that cutting stuff is, I was reflecting on just today. I think the sunk cost fallacy is intellectually simple but emotionally incredibly hard. It's one of those things where it's a discipline of emotion, not insight, isn't it? So if your accountant says, okay, and this is why you've got to have an accountant, they get the numbers. Sorry, what's going on with my camera? They get the numbers and they show it to you and they say, okay, so by the way, Mr. Entrepreneur or Mrs. Entrepreneur, that you've got 100 SKUs. These 20 here are losing a lot of money. And the obvious conclusion from that is, I'm responsible for my business, therefore I must cut these SKUs. And I see very, very few people doing that. I see they cut everything else. They cut the ad spend, they cut the staff, but they don't want to cut SKUs because they feel like there's some kind of brand value in having them out there at a loss or something. What's your response? Do you have the conversations like that? And if so, what do you say to clients?
I wouldn't directly, I usually don't tell them directly, you need to cut these SKUs.
Yeah, it's a bit brutal.
Because then it's my decision and my statement, and that will put them in the defense. I'm asking them, this SKU is making a loss. Is there a strategic reason to keep it on? And they'll start looking for reasons because it's often an upsell for this one, or it's brand value here. But if you challenge those assumptions, that layer of emotional protection or the sunk cost fallacy will peel away. And in some cases, there is a really like an anchor product that's the brand maker. Sure, fine. If you need to make a loss on that to bring in the margins with the adjacent products, that can be a legit strategy. But again, it has to be a very, very deliberate decision for that.
Yeah, I think a lot of people use the word loss leader or they use the word brand because they see bigger corporates doing that. And like Tesco's can sell me, or Walmart in America can sell a loaf of bread for 25 pence or 25 cents, and it costs them a pound, and they can afford to make that loss because they run on tiny margins but crazy amounts of revenue. And also they are funded by bonds at a low low loans that last for 10 years, so they've got stable investment, and they're funded by stock market investors. So I think that we can be fooled by the behavior we see by the big corporates that we interact with as customers every day, right? I think that if we start doing that sort of stuff, it can quickly lead to a bit of disaster. I mean, do you see that ideal of loss leaders coming up a lot with your clients?
I don't see it coming up a lot, but where I see it work really well is if there is like for example, the Nespresso machine, that type of product, where the product or your printer is in the old days was the typical one, where the machine is sold at a loss, but the consumable behind there is the margin maker. That is where it works really well.
Yeah, and that's a bit like the kind of idea of the Kindle, isn't it? That Amazon famously, doesn't give high price tech. And if you want high price tech, you go to Apple and they make a large profit margin on that. But the Kindle probably, I'd imagine, sells at a loss or at break even, but they make a lot of money from the content they sell you. So yeah, it's the same idea. And by the way, that's a very interesting business model that's probably underexploited, being that the cartridge printer machine. I always looked at that, and I've got a laser printer partly for that reason, because I always looked at that and I thought I'd love to be on the selling side of this, but this is a disaster as a consumer. You spend huge amounts of money, $40 printer or $50 printer, and then you spend $200-300 on printer cartridges. But yes, you're right. Apart from that, then there's probably not so much justification. So let's come to this. By the way, great content. I'm loving this because it just ties in with the reality I see with my clients when you really get into the numbers. And this feels very real to me. So that this may be tough to hear, but yeah, somebody was just saying, yeah, this is how I actually operate. Yeah. So let's move on to the person who's taking too much risk, especially first-time entrepreneurs. So who's vulnerable to this? Well, you've mentioned first-time entrepreneurs. I guess what are the signs that you're doing this? When do we need to say there's a red flag coming up for this particular issue?
Well, I clearly see it if they tell me the plans and the plans are completely disproportional to the rest of the business. But if for you yourself, the thought experiment there is probably, if this fails, what's the consequence? Will this impact the rest of the business? And if it does, you really want to think twice before committing to it, or see if you can stage gate it. Product launches is the number one thing where I see this happen, where sellers have this vision that, oh, this new product is going to be the one, and they're investing all their available cash in it. If you catch yourself thinking, oh, but this new product is the one, hit the pause button and really challenge yourself if that's true. If it's really that sure, and if there's objective confirmation for it, or if it's your expectation. Just because your competitor sells 40,000 units per day doesn't mean that you will.
Yeah, is there objective confirmation of your vision? Yeah, I guess that the hard thing with entrepreneurship is that it does require a leap of faith sometimes. But what I
Yeah.
would say is that that's more that the thing that you said that strikes me as a really great reality check is, if this fails, what's the consequence? Will this
Yeah.
impact the rest of the business?
Mhm.
Frankly, from my experience, is often an optimistic question. You know, will you have a business, or will it impact the rest of your financial life? I mean, that's when it worries me. So I refuse these days, because I want to sleep at night. I refuse to do private label training for somebody who's going to put their life savings into one product. I'm just saying, like, I'm really sorry, I'm not going to work with you. Or they want to borrow money, God forbid, borrow money from their family is my favorite, disaster scenario. And like, okay, so let me get this straight. You want to borrow money from your family to launch a product in a space where you have no expertise. And yes, you're hiring me. I get it. I will improve it, but I can't wave a magic wand and tell you the future. If I could, I'd be charging crazy, crazy money. And
Yeah.
then you can afford me, because you'd be spending all your money on my fees. And yeah, and then, okay, this is your kind of life savings. And what if this doesn't work? So I do see the scenario where this hopefully isn't the target listener for the 10K Collective podcast, because it's kind of geared to people who've got established businesses. But if you're listening and that's you, please don't do this. You could do retail arbitrage, you could do wholesale, you could do some Kindle publishing. There are many business models where you don't have to, bet the farm. So
Yeah.
thank you for that. Now, I guess the solutions then, what are the solutions to that person's situation?
In my eyes, the best solution there, it's not about, oh, you shouldn't invest, but in stage gating it. So step by step, commit a little bit for the first step, and then anchor. Are you on track? Is everything that you made in your plan, is that validated? If yes, then go to the next step. And then again, after a certain period of time or a certain amount of budget, stop, take a breath, evaluate. Is this still valid? Is this still working? Are all the signs still green? Is the market validation there? Is the initial listing there? Is is everything that we want to invest on or below budget so far? But again, especially the market validation there is usually the critical one. If that is there, then go on to the next step. But
Yeah.
always make sure you have an out and a go, no go moments.
Yeah, really like that. And by the way, it's exactly how I structured things over the last several years for the private label training. It's like, okay, if you can possibly find any way at all of testing this at a smaller scale, even if it's
Yeah.
at a moderate loss or break even, I'm absolutely happy with that, because that gives you a go no go moment when you
Yes,
maybe invested $2,000-$3,000 instead of 20 or 30,000. That's
exactly.
really, really important. Thank you for reinforcing that. I would say also, market adoption is really critical. So I think it's Mark Andreessen, the really famous venture capitalist from the Silicon Valley, says there's before product market fit and there's after. So he sees it as kind of two different universes. He says before product market fit, and by the way, this is in the venture capital back world where they have a lot of cash to start with. So this is not something you should do at home if you don't have a lot of cash. But he says you basically do anything it takes to get product market fit, and then after you've got that, then you've actually got something to play with, right? So I would say that often people push for product market fit, and the market's just going, no, we're not actually interested in your product. um, when you come across that kind of situation, what are the signs? When do we, that $64,000 question, when do we say, I'm going to abandon this product, it's not working? How do you make that judgment, or how do you advise people to make that judgment?
You don't make that judgment on the spot, because on the spot, Every entrepreneur is overly optimistic. There's always an argument to keep going. You want to make that go, no-go decision objectively beforehand. These are the criteria. And if we don't meet those, we stop. Or if we do meet these criteria, we go ahead. But you want to make those criteria earlier in the process and not on the moment itself.
Okay.
Because you get into like the gambler's addiction where, but the next round is going to be better, or there's one more step to do to validate. And before you know it, you're still neck deep into the mud. So that decision is beforehand and it's cold, so that it takes all the emotion out of the decision itself.
Yeah, I love this. I mean, this is so hard to do in the moment, and this is that sort of entrepreneurial wisdom that is completely different from managing an existing business, because you don't have that kind of challenge, which is Seth Godin put it in its simplest form. He said, okay, before you go into something, a project, put a time or an amount of money beyond which you just kill the project if it doesn't hit X by Y time, and it's brutal and everyone hates it. So you kind of have to have that conversation with your business partners, investors, before you get there, don't you? And yeah, that's super hard. I mean, as you say, the gambler's addiction is, I mean, somehow Amazon has gamified Seller Central in a certain kind of way. I mean, it's the world's most disgusting interface, considering how wealthy the company is, and also they treat us, you know, very badly sometimes as third-party sellers, and we all know this. But nevertheless, there is something extraordinarily addictive about it. So yeah, you're right about that mentality that can kick in. Apparently, by the way, just a side note, but probably not a side note, since mindsets come up organically somehow. There's a process called fractionation, which is known in the hypnosis and sort of not mind control, but getting people into hypnotic states, trance states, which is to say that if you give people rewards sometimes but not others, that's apparently one reason why gambling is more addictive than if you just put the money in the slot and got a guaranteed return. And all entrepreneurship has an element of that, doesn't it? So the fact that it's variable, and the fact that you have that day where you sell 100 units even though you've normally sold one a day, that, you know, particularly in Q4, can really give you the feeling, oh, but it could work. And so I like that objectivity a great deal. So an excessive focus on one metric, that's not something I've heard people articulate before, but I've absolutely seen it. So as soon as you said that, I thought, oh, wow, yes, I see this. When you say, oh, revenue is a disaster, I agree.
Yeah.
It's extremely prevalent, isn't it? Customer acquisition
It
cost is
is.
perhaps more obscure, but nevertheless.
Yeah.
So what are the signs that you're falling into that?
Ooh, that I don't think that's easy to answer in a very generic way, because it really differs on which metric and which company and which business.
Okay,
but
so
if you wake up, if you wake up in the morning and you only check how many units you sold and what the revenue is, and you don't look at the profit, and your year-end target is only expressed in revenue, probably you're somewhat vulnerable for it.
Yes, I would say, by the way, to forgive anyone out there who's doing this, first of all, I've done it a lot, and it's very easy to do because Amazon makes it very easy to see that. They don't even really make it easy to see what your advertising is costing you. Obviously, they have a cost, but I would argue that's kind of a BS metric that gives you the feeling of control without having control, because it's not measured as a percentage of your overall sales for a product, really. So I think it's a apparent control that isn't. But I would say also, yeah, it's hard to get profit, isn't it? It's hard to figure that out. It takes a lot of sweat, and you've got to do the plunging into the numbers, hiring a bookkeeper. So that's really hard. And I guess what we're saying is, please do that work because it's really worth it. One question that's coming from the Facebook user is a really good one, which relates very much to some of the stuff you were saying about paying yourself first if you're in that situation.
Yeah.
What are your thoughts about the profit first model? I think I've got it. Here's Mike Mikalovich, isn't it? Where you pay yourself first and make the rest of the money work harder. When should we apply that, and when should we, use that with caution?
Profit first works really well if you're a stable business. If you are, for those who are not familiar with profit first, their theory is basically you take a percentage of the revenue, allocate that to your profit, and you pay that first. And then you have a certain percentage of your revenue available for all sorts of different costs. And if you're having a relatively flat business, that works really well, because it pushes you to focus on profitability, and it allocates the budget for your overhead, for your marketing, for your office, whatever. If you're a high growth business, on the other hand, I absolutely recommend against it. If you use profit first in a high growth setting, and in the beginning of the year, you say we allocate 10% of revenue for office and for marketing, but at the end of the year, your revenue is 3 times what it was in the beginning. If you stick with that percentage, you're also going to spend 3 times as much on your office and on your marketing and on other things. So it leads to overspending on overhead. So for a stable business, it works really well. It's a relatively easy 80-20 approach. If you're high growth, please be very careful, or you have to readjust the percentages every month or every quarter, but that kind of takes the value away from it and makes it still very, very tedious.
Yeah, interesting. I like this a lot. I mean, I think yeah, sort of hacks and simplification. Simplification is a great thing because it often requires brutal honesty, and it forces you to have disciplines, which is a great thing. As to the points we're making today, right?
Yeah.
Honesty and discipline seem to be kind of some of the underlying themes. But yeah, it's a very good point that if you increase your overhead in proportion to your revenue, you're quite often going to have nasty side effects that mean that overall your profit will decrease quite rapidly because quite often you'll find your gross margins challenged by and you're going to have various other costs that creep in as well. Never mind, without even talking about inflation and supply chain costs and ads going up 50% year on year on Amazon. Maybe it's been more than that from the stats I've seen. So yeah, I think somebody's talked to my podcast co-host Jason Miles, who calls himself a sort of profit-driven entrepreneur. He and his wife are very aware of their profit and loss statements, and he talks about trying to widen the jaws so that if you grow your business, the percentage of profit you make actually grows as well.
It should, yes.
Yeah. So tell us a little bit about that as a goal. So I guess that how do we kind of go the opposite way to all these classic errors and actually make sure that our businesses are both profitable and over time can pay us for that lifestyle that we want as well?
If you're making the budget, there's 2 things I would do. One is you have a gross margin target. So what percentage of your revenue should be the gross margin? That's the one. And that is a percentage of your revenue, and that should creep up a little bit. That's probably not going to jump up a lot, simply because you can't cut your product cost in half. You may cut off a little bit left and right, but that's not going to change massively. That is something to keep in mind when you're launching new products, that the gross margin needs to be at that benchmark or higher. But your overhead, you don't want to forecast that on a percentage of revenue, but that should be forecasted in dollars or pounds or whatever your currency is. Because that means if your revenue grows, your gross margin percentage stays the same. So your gross margin in dollars goes up and your overhead stays the same in dollars. And that means that what you call it, the jaw is opening. That means you get a higher net margin percentage, and therefore also in dollars.
Okay, that's really, really good. So simple rules of thumb, have a gross margin target, get it to creep down, which by the way, if you're selling more and you've got good branding, you should be able to keep the price high because your branding's strong, and then you definitely should get economies of scale from any producer worth their salt. If your MOQ is 10,000, you should be getting a better unit economics than one. And of course, if you can fill a container as opposed to less than container load, the shipping cost per unit drops down greatly, and that's when you really get the economies of scale, right? So that should definitely be doable. But your warning about the overhead is really helpful. I think people are even less organized than that. In my experience, that they just add overhead because they generally feel there's money in the business. They don't even do a budget. It's not a percentage of anything. They just add a member of staff because they feel they
Yeah.
should be doing social media marketing. So if somebody's in that kind of situation, what are your thoughts for them?
Actually, and that what I mentioned earlier, make a plan. If you don't know where you want to go, if you don't know what the destination is or what the destination looks like, you also don't know what the road is to get there. So you really want to make a plan, break that down into how does that road look like? What metrics do I need to track to get there? And then follow up on that. Keep that as your guide every month or every quarter.
Amazing. All right. So, 2 ways to go with this. I think this, first of all, this has been great reality check. I feel like we have to offer people a solution on how to make a plan. Maybe that's going to be for a separate podcast recording because this feels like it's been substantial enough for people to take on board, and they're still sort of reeling in the corner from the reality that maybe they're doing some slightly dumb things financially, but it's much better than waking up one day and finding out your business is bankrupt by a large factor of of greatness there. So let's tell us a little bit more about yourself and what you offer, because obviously you've got a lot of wisdom that is a blend of some kind of common sense, aka strategy. Sometimes I think the two are quite similar. And do you have a plan for growth? What do you want to do with your business? Kind of common sense questions, but also strategic ones.
Yeah.
So what do you offer people who want to work a bit more closely with you?
One of the things we do when we get started with a new client, we always start with what we call a game plan. And that's exactly that. Identify what the personal goal is, translate that into the business goal, break that down into what metrics you should be looking at to monitor your progress, and then translate that into what does your accounts need to look like, what does your bookkeeping need to look like, so that you can actually get the right information from your books and from other platforms, so that you can actually measure the progress properly. So that's the number one thing we do to start with any new clients.
How do people work? Sorry, I'm using 101 here. How do people get hold of you, and if they want to go further with this game plan, which sounds really intelligent to me?
The best way is to go to financeinsightmatters.com/amazingfba. That is where you will find the link to the game plan, and that's where you also find the discount code for it, specifically for the listeners of this podcast. And alternatively is to connect with me on LinkedIn.
Great, that sounds easy enough. And I know that you offer a free personal audit as well, which, having spoken to you today, even for myself, or let alone for some of the clients I've worked with over the years, that feels like a really wise thing to do. So how do we get hold of you for that personal audit?
You go to financeinsightmatters.com/mini game plan.
And what sort of things are you going to see from that audit?
Basically, it is a quiz with a few questions on how big your business is, what your goal is, how many SKUs you have, these kind of things. Because that gives us like 80% of information with just 20% of the questions. And what you're going to get from that is a personal video from me within 24 hours that lists what we would see as the metrics you would have to look at. Again, this is the 80-20 version because you really want to do the full game plan to get the exact picture and the whole translation. But the 80-20 is this few questions, and we'll get you a list of metrics that fit your goal and your business.
Great. So it sounds like pretty much everyone should check. I'm presuming that's a free audit anyway.
That one's free, yes.
Yeah. So pretty much everyone listening, I think, even if you just go on it and discover that you're doing everything right, you probably should at least check it. financeinsightmatters.com/mini game plan. Sounds like extremely worth doing. And then if people want to take it further, then they can go to financeinsightmatters.com/amazing FBA if they want to take it further with you. And I guess that people are often reluctant to spend money on consultants and coaches because it's harder to see the value than advertising, where you get the addiction, feeds the addiction, or what do you call it, the dopamine hit of a sale, or in a product line where you can stroke your products and look at it in the packaging and think how beautiful it is. But the truth is that if you're driving blind, you're really in danger, and you may not even know it. So I would just really urge anyone to, if you're not going to talk to Rob, at least talk to your accountant, talk to somebody who's financially literate and understands the e-commerce space. Because when you do, I know from experience that you're going to have some moments where you go, I wish I didn't know this, but now I do. But then you've got a chance to turn it around. So I think it's really important work to do. And Rob, I think that you've proven how much common sense you've got in this area, which is actually ironically not common. We have entrepreneurs doing stuff, and then we have accountants producing numbers, and that gap is often there. And I think you're the perfect person to fill it. So thank you so much for sharing your wisdom. Really fantastic stuff.
Pleasure to be here.
Okay, so that's our first recording done. So thank you for your comments. If you're listening or watching, do keep them coming. Some good questions about profit first and so forth. So Rob, how are you doing for time? Because it feels to me like what we officially were going to do is talk about profit versus cash flow, which I think is a really important topic. But it feels to me possibly that we should talk about how to make a plan instead? What are your thoughts? I could go either way with this.
I personally prefer the profit versus cash flow one because I see
Okay,
that
that's
distinction go
interesting.
wrong
Yeah,
quite a bit,
amazing. That's a good
and
distinction.
that's really my pet peeve.
Yeah, it is mine as well. So okay, fine. Decision made then. Let's crack into the next recording. And do you have a hard stop, by the way? So I've let the time drift earlier here.
I have a semi-hard stop at 4.
Okay,
I
fine.
think we're overrunning this one a little bit.
Yes.
Um,
Okay. We'll try and keep it nice and top then. Try and do sharp 25 minutes then.
Give me 1 second. I'll inform my next call that I will probably be a little bit late.
Okay. Okay. Right. So everyone listening live, very unprofessional looking, but this reality is right. Nevertheless, I will try to talk less and ask more intelligent questions. So stay out of your way. Right then, let's do this thing. Ladles and jelly spoons, boys and girls, welcome back to the 10K Collective podcast, the place for 6, 7, and 8-figure Amazon and e-commerce sellers, a subset of the amazing FBA family of podcasts. Today we're talking with Rob Te Braake of Finance Insight Matters, and we had a fantastic discussion, I think, about personal wealth goals and your e-com accounting. Today we are going to be diving into the difference between profit and cash flow, which I think is really important, and I think it's the difference between bankruptcy and happiness myself personally. So Rob, thank you for coming back to the show.
Thank you for having me again. I'm looking forward to this one.
Yeah, I'm bigging this up, and me too. I'm not an accountant, but I can see enough of the businesses I've seen over the years to know that this is a critical distinction, profit versus cash flow. So first of all, let's define terms. What are we talking about? What does profit mean? What does cash flow mean in simple terms?
Profit means if you look at the P&L that your accountant gives you, the number at the bottom, the net profit, that's your profit. So if you sold 100 products for $100, no, let's skip the numbers for now. It is your revenue minus all the costs that you make for that revenue. So minus your product cost and your overhead costs.
Okay,
that
so
is your net profit.
We're not getting into tax then today. So presumably we're sort of pre-tax profit, that kind of level, roughly.
Pre-tax, post-tax.
Yeah.
It makes a difference, of course, but for today's discussion, not so much.
Okay, fine. And
cash flow is the difference what on your bank account between the beginning of the period at the end of the period. So January 1st, you have $100 on the bank. December 31st, you have $200 on the bank. You have $100 positive cash flow.
Okay, great. So
doesn't mean if you're profitable or not.
Yeah.
It only says you have more money in the bank.
Yeah, great stuff. So why does this distinction matter then? That sounds on the surface of it like something that accountants should stress out about, but we're all just busy trying to grow a brand and develop new products and get the marketing working and yes, get some gross profit margin if we're really measuring intelligent metrics, or if we're really feeling dumb just measuring revenue. But that's the focus. So why do we need to care about this distinction?
At the end of the month, you need to pay yourself, you need to pay your team, you need to pay your office rent, you need to pay your ad agency. You can't pay them with profit. You pay them with cash. So if you are super profitable, but your bank account is empty, you still have a problem because you can't pay what you owe. If you look at Tesla as a famous example, has never been profitable, always makes a loss, but has money in the bank, and therefore they can pay, therefore they can survive. Companies don't go bankrupt because they are making a loss, they go bankrupt because they can't pay one or more people or companies that they should pay.
Yeah, that's a stark reality. And by the way, the word loss is somehow, it's a very particular meaning in the world of accounting, hasn't it? But it feels like similar to cash flow, but it really isn't. So a loss is something on paper and cash is something in the bank, right? So
absolutely,
I think it's really important. And also it's very dangerous in a way. I sometimes feel that to compare a small business with large corporates, because they have completely different financial structures. But there's quite a lot of companies like Tesla, also Amazon for many years, that had no profits but had very healthy cash flow, and they still seem to be the biggest companies on the planet. So what are the mistakes you see e-commerce operators making in this particular area of profit and versus cash flow, or maybe confusing the two?
By far the biggest one is people focus on the P&L only. So they focus on revenue, if they're a bit more sophisticated on gross profit, and if they're a little bit more sophisticated on operating or net profit, but still forgetting the cash flow. So that is by far the biggest one. The second one that we see is people that grow too fast. And that may sound weird, but an e-commerce business that grows too fast is at high risk of breaking if you don't manage that, if you don't manage your cash flow properly. And a more detailed one, we see people when they negotiate with suppliers, they focus on the purchasing price only and they forget the payment terms.
Yeah, I like that a lot. Only the price, yes. So they're looking at unit economics and they're completely forgetting about the fact that when you pay makes a huge difference. I would say that one of the biggest things you can do is simply to negotiate better payment terms with your suppliers. And even if you don't change any of the unit economics, it means your business might survive if it's going fast, and B, you can probably afford to do lots of things like actually pay yourself, but also you might be able to expand your business more quickly. I think everything relates to that, doesn't it? So what would you say are the solutions then? So if you're only focusing on the P&L, what do we need to do instead?
Well, the obvious answer there is focus on your cash flow, and then more specifically operational cash flow. And I think in a bit we'll dive in a little bit more in the different types of cash flow. But as I mentioned, you won't, if you're making a profit or a loss, doesn't make an impact on going bankrupt or not. An empty bank account is the one that kills you. So if you're only looking at the P&L, you don't have visibility on your cash position, start focusing on that. Because that is, especially in e-commerce, the critical one, where you're pre-funding your inventory, where you're pre-funding your shipping costs. With a bit of bad luck, you're pre-funding your ad agency or your ad spend. And then at the end of the ride, you get paid because you finally sell the products. That cycle you need to understand and manage.
Yes, that makes sense to me, 100%. I have a lot of conversations about this, by the way, with my clients. So I'm really glad to hear somebody else, really, really hammering this in public, because somehow people neglect the nature of the beast, don't they? If you've got a ton of money tied up in stock, I would guess that it's fairly basic that you could have $100,000 worth of stock at the beginning of the year and $200,000 worth at the end of the year, and you've made $100,000 in profit. And that's what profit means, isn't it? The difference of the value of the business. And I think people get massively confused about this. The second thing, then, growing too fast. That's growth sounds great. Everyone makes a sort of almost a religion of growing, especially fast. It somehow seems to be a thing that Amazon sellers do, above all American ones, but not just. I mean, British ones I work with, or I've got a couple of Dutch clients I've worked with, and they seem just as obsessed. So why is that a bad thing? And what are the danger signals that it's going too fast as opposed to just fast?
It's not a bad thing. It's a dangerous thing if you don't do it properly. So, and that correlates really strongly with how long your lead times are. If your supplier is next door to the Amazon warehouse and they deliver out of inventory, so your lead time is basically 1 day, you'll be fine. But especially if you purchase overseas and there's a longer shipping time, you probably pay your supplier when you place the order. Then they spend 6, 8, 12 weeks producing. Then the stuff goes on the boat. Then it waits on the boat before it arrives in the US because delays are everywhere. Then you pay the supplier the second portion of the payment. And then it arrives in the warehouse, and then you can finally start thinking about selling it. So all that time between your first down payment and you actually start selling the units, you pre-finance that inventory. And if you do that with one batch, probably that's not a big problem. But if your growth is accelerating, you have to pre-finance more and more and more inventory. And you have to buy that inventory 2-3 months before you can actually sell it. So you have to buy even more if you're planning to grow aggressively to make sure you never run out of stock, because obviously you don't want to do that. But that means that the amount of capital you need to put into inventory compared to the size of the business gets really, really large. And that in 9 out of 10 cases means you can't finance that yourself. You need external financing for that. But that takes time to arrange. So if you don't realize that that problem is coming, you're going to be caught off guard, and you're going to either run out of inventory, or you're going to have an issue with your supplier, but you're going to get into trouble. Yeah. One of our clients in consumer electronics, they had to fly in their stuff from China to Europe, and where they would usually pay, I think it was $3 per unit in shipping costs by boat, they were paying about $80 per unit for air freight. And say goodbye to your margin.
Yeah, I guess that's more of a profit and loss issue in some ways. Well, that's a sort of conflict between the two, isn't it? Because if you're flying stock in, you can get it selling a hell of a lot quicker, so that's good for cash flow, but it's horrific for your margin. So sometimes there is a conflict between the two, isn't there? I mean, yeah, I would say really, here's the thing, my sort of 50,000 foot view of the business model of private labeling / custom products. If you're importing, everyone thinks it's about more and more products and profit margin. I would say it's about balancing the cash flow, which means you can survive and expand, versus the thing of never going out of stock. And that basically means you just have to borrow or invest huge amounts of money, in my experience. I mean, people are very naive about this. And it's often put across, let's put it politely, disingenuous marketing, which is to say, very exaggerated, that I'll just build a lifestyle business. I mean, I would suggest at this point in proceedings, and I'm a person that makes some of his living from coaching people in this, and I'm telling you, if you're listening or watching, please don't, you treat private label like a lifestyle business. It's not really suitable for that anymore. It used to be more. Tell us about negotiating with suppliers on only price then. So that implies we ought to be talking about the payment terms, I guess, doesn't it? So what are the things we should be doing?
Well, not only the payment terms. The payment terms is the obvious one. If you get better payment terms, you pay later, therefore you have better cash flow. That's the obvious one. If you have a relatively shorter physical distance from your supplier, so if you're buying if you're selling in the US and you buy in the US or in Mexico, for example, another really good example is lowering your order quantity. So in general, that means less good unit economics, higher purchasing price. But if you have a good bond with your supplier and you say, you know what, we're going to order 10,000 units, but I would like to split that in 2 orders, one now and one 2 months from now. You ship in smaller quantities. That means you effectively still buy later and therefore pay later. If you're going to buy from China, and that means you're shifting from full containers to LCL, probably that doesn't work. But for big enough quantities or shorter distances, lower order quantities and higher order frequency is a really good way to effectively get better payment terms.
Yeah, and I guess there's a direct payoff there between your profit and loss statement, where your unit economics look worse if your order, say, a few thousand units as opposed to 20,000, versus the cash flow. I would take the cash flow because if you've got enough of a margin to be acceptable, then I would say that you're actually going to survive further. I mean, what are your thoughts when you've got that difficult kind of payoff there?
Oh yes. First of all, hands down, I'll take the cash flow. Assuming the unit economics are good enough, I'll take better cash flow. But the thing is, if you have a good bond with your supplier, you can still, because you commit to 2 orders of that same higher quantity, you can still get the same unit price, but split it into 2 orders in practice.
Yeah, and it comes down to how they book. And I guess this is it feels like a sort of accounting sleight of hand, but I don't think it is fooling anyone. It's just that revenue is often booked when you put a purchase order in for a manufacturer, right? So that basically means they can go to their boss and say, Mike's put in an order for $50,000 worth of units for this year. And they can go, great, revenue 50,000, our manufacturing cost is whatever, we're allocating a percentage of overhead to that, we're going to make 40,000 out of this, or whatever they make. But actually, you're going to pay them now for the first batch, and then you may not pay them for the second batch until maybe it's next year, right? So the cash flow is completely separated, and that's a super smart thing to do. And I've seen people do that a lot. And by the way, thank you for flagging that up. We've had it mentioned on the show before now by an aggregator actually, but he was an e-commerce operator himself. But it's not common, and it's really, really fantastic advice because it's great for everyone. Because really, what the manufacturer needs isn't necessarily cash flow in their case, especially if they're in China. they're funded by the Communist Party that does all sorts of crazy stuff, and whether that blows up one day and pushes the world into recession is another question. But right now, they basically don't seem to have any problem with throwing credit around like it's water. So they don't have a problem with that, but they want to book sales where you have a massive challenge
Exactly.
with cash flow. So yeah, that's really, really helpful. Now, there's certain types of cash. You've mentioned types of cash flow, so we ought to get into that a little bit as well. So operating cash flow, you mentioned. What are these types, and
Yeah,
yeah, let's identify those
with the risk of getting too theoretical and academic, but there's three types of cash flow: operating cash flow, financing cash flow, and investment cash flow.
Okay.
And investment cash flow is probably the least relevant one for e-commerce. That basically means if you buy a warehouse, or if you sell a warehouse or real estate or a really big asset, probably not that relevant for most of you. Financing cash flow is when you get a loan from the bank, that is financing cash flow that you receive. Interest that you pay, loans that you repay, or dividends that you pay to yourself, all of those are cash flows that relate to how you finance the business. So that's a separate category. And operating cash flow is the most important one. That's the cash flow from actually running the business. So all the money that you receive from your customers, and the money that you pay to your suppliers, to your colleagues, your own management fee, normal cost of the normal cash flow of running the business. And in the long run, every business needs to have positive operating cash flow. You can buy time and have negative operating cash flow for quite a while if you have sufficient cash flow from financing. So if you have investors that keep putting money in, or you have Amazon loans that you keep drawing, you can run with negative operating cash flow. But in the long run, any sustainable business needs to have positive operating cash flow.
Yeah, that's a really important. By the way, this is an important thing for anyone who's considering investing in Uber or any other sort of tech startup, because they are funded. I mean, Uber, I think they got a $3 billion tranche of funding from the Saudi fund, whatever it is called, the sort of Saudi fund for basically trying to the best out of just being in oil. And there's lots and lots of businesses that look kind of sexy for a while, and then eventually people look at it and go, the emperor's got no clothes on.
Yeah.
And it dies. So your business isn't going to have that luxury, is it? If you're in the Amazon space, I mean, what are the areas that you see people making here? Apart from, I guess, the main thing is not having positive operating cash flow. But what are the sort of other things that you see?
The biggest one that I see, other than not having positive operating cash flow, is the fact that they don't distinguish it. They would equate money coming in from a customer with money coming in from a Amazon loan. And therefore they say at the beginning of the year, I had less cash than I have now, therefore I have positive cash flow. And that's a very dangerous misconception, because that Amazon loan has to be repaid.
Yeah. So financing cash flow or money from loans versus operating cash flow.
Yeah.
And you just made the distinction. I guess cash flow from a customer, they've got the product, they've given you the money, that's it, done. Whereas the
Yeah.
difference between that and loans is the repayment side. What problems do you see people getting into with loans then? Tell me a bit about that.
Um, Problems getting into, surprisingly little, because Amazon loans, Shopify loans, Stripe financing, all of those revenue-based ones, they just take the repayment. So I don't really see that escalate into troubles. I mainly see that people underestimate the price of these loans. It is super convenient to take them out, and Amazon hands them to you on a golden platter, basically. But the cost is quite high. So if you are having a stable business, it's 9 out of 10 times cheaper to knock on your local bank's door or other more traditional forms of financing to get a loan from there rather than take the Amazon loan.
Okay, interesting. So it's just the cost of the loan really, and I suppose that sounds to me like a profit and loss element, which is the cost of finance, but also I suppose it is affecting cash flow in some ways. But it sounds more like almost a profit and loss thing. And I guess the reason, to be fair, that people don't get loans from banks is it's not easy to get a loan from a bank compared to Amazon financing, is it? I guess that would be
True.
outside the scope of today to say how to do that. We've certainly talked about that with quite a few people over we've talked about every financial topic at some point, I think. But I do think it's important to say it's worth the sweat because of what you've
Yeah.
just discussed, that really, if you're spending more money on finance than you should, it's really going to hit your profit margins. Um, okay,
The other
so
thing,
yeah, go on.
quick jump in here, is I see people poke with their suppliers on unit cost, therefore ignore the payment terms and then have to borrow to pay their supplier. And therefore, if the time that they're borrowing the money, the interest you pay on that is actually, you could consider it part of the unit cost as well. So it may be cheaper to not need the loan, pay more to your supplier at a higher unit cost, but pay them later.
Interesting. Very interesting. This is sophisticated financial operation that you got now. And this is why you need to sit down with somebody who gets this stuff, I think. So, in other words, if you treat your, I like this a lot. I've never heard anyone put it this way, but it makes sense to me a lot, which is you treat your finance incurred only. So, in other words, you've got a loan in order to fund inventory, and in particular type of inventory. So, you've got your bestseller product, you need to build 100,000 units before you get into Christmas. So, typically, you're buying from China in what? August, maybe even July these days.
Yeah.
And you have a spike down in cash flow. So in order to get that, you get your loan. So instead of which you take the hit with the supplier, and actually because that's yeah, the economics of that might work out cheaper than a loan. I like that a lot, and that's the sort of thing where you really just got to have. If you're not on top of your bookkeeping, you're just going to have no clue what we just talked about, whether that's happening in your business. I
Yeah.
think so. I guess you've got to have a bookkeeper, and it strikes me also you've got to really. Have somebody who can talk the stuff over with you. So that really brings me, I mean, we can talk about some other things. It's kind of forcing me into a call to action here because once you're getting into this stuff, the nuances, you have to have some help, don't you? So tell us about what you do to help people because it feels like an inevitable moment has arrived. What do you do for people?
We offer help, but primarily in two parts. One is accounting and bookkeeping. Second one is reporting, translating all the data and the treasures that are hidden in the books into visible, actionable information, and help you analyze and translate that into what it means for your business.
By the
And
way, I just,
that,
sorry, go on.
yeah, and that means revenue not only overall, but we would look at revenue per product type, revenue per geographic area, gross margin and net margin per product type to really understand where are you making the money, where are you losing money, where can you improve, and above all, how is your cash flow and where can you improve your cash flow?
Yeah, and I think there's the world of difference between, and by the way, if you are not anti bookkeeping, bookkeeping is utterly important. And most of us, myself included, just sweat and fight with it and work with people and have arguments. And you just got to do the thing, I think. But what you're talking about is, and then turning it into visible, actionable information, which I think is
Yes.
the missing piece. And you're clearly, very good at that because you've got very pragmatic understanding of the business model and where the danger points are, and equally where your opportunities are as well, which is, I think, really exciting. And here's what I would say to anyone listening who's got a bit depressed by now. There's lots of mistakes people make because they have no clue what's going on in their business financially. But if you get the clue and you're willing to look at the difficult truths head on, I promise you that most of your competition is not doing that because I work with them. And, if you're willing to grasp the nettle, you can get a competitive advantage that nobody can reverse engineer on Jungle Scout or Helium 10. Nobody can tell from the outside without seeing your books why you're doing so well. And it's the ultimate competitive advantage for me because it's so uncommon. Lots of people are good at producing beautiful products. Lots of people are not good at this stuff, I would say. So, with that in mind, you offer a couple of services, don't you? So, you've got a free personal audit, which sounds
Yes.
cool. Tell us about what we get from that.
What you get from that is basically you put in you answer a few questions on your business and especially what your goals of your business are, what you want to achieve with it. And then we're going to reply you with a super personal, tailored list of metrics that you should be tracking to actually help you achieve those goals. And I can promise you, operational cash flow is definitely one of them.
Yeah, definitely. That sounds, yeah, really, really, really important. And it's not a phrase that I hear banded around. So it's really great to get clarity on something that somebody else doesn't. Again, it's a competitive advantage. It's not just about, oh, we're doing things wrong. It's like, if we get this right and everyone else doesn't, we are going to survive when they don't. And then we take their market share and their profits. Thank you very much. So the other
Yeah.
thing is then, if we want to get into a bit of a deeper work with you, you offer what you call the game plan. So how does that work?
Yeah. The game plan is essentially a more extended version where we take your goals, dive into in a deep call with you, understanding what you want to achieve, how you want to achieve that, translate that also into the KPIs, but then with much more information, so more detailed, and then translate that into what does that mean for your accounting and your bookkeeping? Is it set up in the way that you can actually get these insights from it? Or what do you need to change in your accounts so that you can actually measure and track and use those insights from your books? We'll set up those and an implementation plan on what you need to change and who should change those.
Love it. And this is at, I believe, financeinsightmatters.com/amazing FBA. And
Correct.
any special deals for listeners and watchers?
Yes, there is for this audience a 25% discount.
Great. Can't argue with that. But I think more than anything, what I'd encourage everyone doing is watching or listening to do is go and talk to somebody like Rob. I mean, I would suggest go and at the very least get the free thing, which is financeinsightmatters.com. Sorry, financeinsightmatters.com/mini game plan, where you get the free personalized list of metrics that you need to look at. And do consider working with somebody and paying them real cash money to get advice, because we always want to exchange money for ads, which gives us the dopamine hit of the sales. I've said it before and I'll say it again because it's addictive. Amazon knows that. They're not stupid people, they're smart. And we also want to see the shiny, lovely products, the physical evidence we've spent our money on something good. But I can tell you for free that getting this stuff right, I think honestly the best operators are people I've seen grow from 7 figures to 8 figures in the time they've been with me in the masterminds are really smart financial operators. They are obsessed with brand, but they have like a fractional CFO or a CFO who is really amazing. Most people don't have a fractional CFO or financial director in their business, and they really need this help. So for me,
Yeah.
it's like the ninja master skill that is missing. So really grateful for you sharing that stuff. And my final question to you, Rob, is what question should I have asked you that I didn't?
Usually, this is the point where I say profit is overrated and cash flow is the one. Um, Let me think. I think you covered most of it. Now, if you really want to go more advanced, if you want to go to finance, let's say 102, you really want to start looking at things as working capital turnover, inventory turnover, ROI, ROA, but return on investment and return on assets. But I think we don't have the time to go into that level of detail now. But once you have the basics in place, that's where you want to start looking for further improvements.
Excellent. So for that sort of handful of people who are in the luxurious position where they, got the handle on the basics, we can definitely get you back on the show to talk about that. I'm a weird sort of nerd, as my wife tells me, that I've got books here like Financial Intelligence by Joe Knight, and it talks about and Romancing the Balance Sheet by Anil Lamba. So I love terms like working capital, inventory turnover ratio, ROI, ROA. For those who love that too, we'll get you back on to nerd out about that. But for now, I think we've given people plenty to absorb. I think even the distinction between profit and cash flow and the fact they're different and focusing on operating cash flow in itself, very, very valuable nuggets there. So, Rob Te Braake, thank you so much for coming on the show and sharing your insights.
My pleasure.
Okay, and that's a recording out. Thank you very much for those of you out there listening live today and popping. I don't know if it's one person or three people with your account. I love the comment, accounting yuck, but some great advice and content. So people are being honest about how they feel, but some good questions. So keep the questions coming even after the live, and Rob and I will get in there and try and answer them best we can. So thank you for watching, and Rob, thanks so much for coming on the show again. Real fantastic stuff.
It was a pleasure. I love these conversations.
Me too. Yeah, it's weird, isn't it? We're strange kind of people, but hey, we're obviously in the right job. If you don't love these conversations, that you have an Amazon business and you think it could benefit folks, grasp the nettle here. Don't let it drift. Like, irrespective if you ever pay me or Rob any attention, never mind money in the future. That's just one thing. But I'm telling you, like, it's heartbreaking to see great businesses go past you not addressing this. So address this stuff, please. I'm begging. This is my mic out.